Well, I'm having so much fun now that I'm finally making videos again. It's been a couple weeks, and I want to cover my my method for early rounds of capital. And for a lot of you listen to this may you may not be ready for this yet, but listen anyway because if you're in the game as an investor or an entrepreneur, you're going to hear this stuff a lot. So this is a warm up for you. And the issue is again early stage valuation. What do I value my company at? And because it's so hard and there's no real market, like again, you wrote your idea down on a napkin. I've raised money with nothing more than that. You can raise money with nothing more than an idea on a napkin if you happen to be in the right place with the right person. You don't have your valuation, you don't have your legal. Of course, they're your friend or somebody you know, you're having lunch. You're not doing this over the internet. You're not putting it on, you know, you're not doing some blast. But you are raising capital. So what's that idea worth? I mean, again, there's no real market, but what there is a commitment. There are people who are committed to you succeeding in that idea. The more traction, the more evidence you get that it can succeed, the more the valuation tends to get solid in the minds of people. And remember, since money is just words, we're trying to create something solid in the collective mind of your investors. It's a very fascinating game. And, if you look at the great entrepreneurs, the famous ones, they're very good at holding the energy represented by all those words. And then that energy gets converted into actions, and then they produce stuff. They make things happen. It's a very lovely aspect of being human, how we get together and decide to do things for good, ideally. Not always. Money moves into a lot of stuff that I wish it didn't, but I focus on, I stick to my knitting. So this problem of being able to value properly has been the source of, years of different kinds of discussion. But you'll probably have heard of things like a convertible note. And then over the past decade or so, there was something called a SAFE, which is a simple agreement for future equity. And both the convertible note and the SAFE, in general, especially as used by startup entrepreneurs, are contractual devices to avoid finalizing evaluation. Now, why would you want to do that? Let's say that you might be able to rationalize a valuation of $2 million, and what you really need is $2 million in cash to get to the first major milestone of your company. And in Silicon Valley, there are a lot of people that are willing to put $2 million into a good idea. But you as the entrepreneur, the founder, the owner, if we start with a $2 million pre-money valuation, and then we add $2 million in cash, suddenly the new owner or the new owners, they own 50% of your company. And what happens is it becomes a control issue. And that's really when we're talking about valuation and money coming in and distributing ownership. Small companies are too small to have formal governance, boards of directors, fancy meetings, and, heavy discussions. Pretty much, if you're a startup, you're trying to make enough money to last until next month, pay your bills. You're trying to build a runway while you're trying to take off on the airplane at the same time. So you got your hands full, and you need to be able to have the ability to govern the company basically as a dictator from your position of majority owner. Once the company gets stronger, is really what I mean. Once the company is stronger and it's got money flowing, then you can afford to come up with more intricate governance arrangements. And a good friend of mine, he was number 900 hire at Microsoft in the 1990s, uh, which is pretty early on. And he told me that by the time he got hired, Bill Gates, one of the co-founders, by that time, Bill Gates's ownership had been diluted all the way down to 14%. So even by number 900 hire, Gates no longer owned a majority. He couldn't rule by fiat. He had to rule by governance. But again, in the early stage, you and any intelligent investor will both want you to govern by your dictatorial authority that's granted by owning the majority of the shares. You don't want to get yourself diluted too early. So really, these valuation postponing techniques are for situations where you're taking in way more money relative to the stage of the idea. Like somebody says, this is a really good idea, there's no traction, but we're willing to put a lot into that. And again, these kind of transactions happen mainly in Silicon Valley. So for the rest of us, and we're doing something more maybe not so technical, maybe we're building a chain of restaurants, or we're trying to start some kind of a program of some sort that doesn't rely on the kind of logic that happens in the Bay Area. We don't necessarily need $2 million right away. Maybe we just need a couple $100,000 to go to the next step, and then we'll raise the valuation and onward from there and raise a little bit more. So until someone that shows up at your door saying, hey, I want to swamp, it's called your capitalization table. Your capitalization table spells out who owns how much of the company. So if someone shows up with a big check and they want to swamp your capitalization table, that's a good thing. But you need to handle it in a way that you don't lose control of the company. So that's a more advanced discussion. If you're a vegan entrepreneur and somebody says they want to give you $2 million, come to the website and post a question or in the Facebook group, and we'll help you work through that pleasant issue. But for most of the entrepreneurs, their bigger challenges, they're worried about getting enough investors just to move to the next level. And because of that, we try to use very simple structures. So rather than trying to postpone the valuation, typically for a small company, a real startup for their first round will typically recommend a $2 million valuation. And why is that? Well, in the last video, we mentioned, let's say you've got a $2 million pre-money valuation and somebody puts in $200,000. Now the company has a post-money valuation of $2.2 million, and the $200,000, whether it's an individual or a group, that represents about 9% ownership of the post-money valued company. And people ask me, well, Mark, how can you say this thing is worth $2 million? I'm not saying it's worth $2 million. I'm saying my ability to govern this sanely, we have to come up with these valuations to govern this thing sanely. And to be honest, if you look at these valuation postponing deals, you'll see that you will actually get a worse deal if the company succeeds. If it fails, you're going to lose all your money anyway. That's the main part of this conversation. If you're an honest entrepreneur, when you're talking with your investors, you have to inform them, and they have to sign documents where they agree that the likely outcome is they're going to lose all their money. So now that we've got that out of the way, if they still want to invest, the government says, okay, they know that the likely outcome is they're going to lose all their money, but if they want to invest, we, the government, say okay to that. And they can't come back and blame you for failing because we told you in advance that's probably what's going to happen. People like that, right? People don't have enough excitement in their lives sometimes, right? I don't want to criticize anybody. Everyone has to follow their dream, but some people live very safe but lucrative careers, and they don't necessarily have that kind of bleeding edge excitement that we entrepreneurs get to enjoy every day, wondering whether we'll eat the next week or not. They don't like that, so they took a safer path. So they enjoy the fact that there's risk, but on the upside, the $2 million valuation gives them a really excellent upside if you succeed. And most of these safes, again, you'll see these around, or convertible notes, what they're doing is they're postponing the valuation until a much bigger fish comes in, and then they'll put some valuation cap. Now, if no big fish comes in, the whole thing's kind of, it's a little bit chaotic, which is why I don't like these deals anymore for most startups. These kind of structures, again, convertible notes, safes. Typical safe these days is written at what's called a $4 million or $6 million. I've even seen $8 million valuation cap. That means no matter what they put in, the valuation is going to be capped. If you succeed at all, you're going to succeed big. Okay, that's good, but they're going to be buying in at $4 or $6 or $8 million valuation instead of, say, at the $2 million pre-money valuation. So they're really actually, relative to what I'm saying, taking, they're missing out on that gain, and those first checks are so valuable. So when you understand the $2 million valuation relative to governance, your ability to raise capital and govern, while you raise sequential rounds and build valuation, compared to these valuation postponing activities, it's much fairer for the investor. But it's true, your company's probably not worth $2 million. You can put an ad on Craigslist and sell your company for $2 million. That's okay. Once you have to get okay with the idea, it's about how to start sanely. And a straight equity offer usually has much lower legal fees for compliance. Does your investor want you spending bunches of money on legal fees so that they get a lower valuation down the line? Or would they rather take just a very straight risk, less money on lawyers, and a higher gain if you succeed? When you succeed, right? When I succeed. Well, yes, of course. Never say if. No, you want to be honest. Not honest, it's a risk, right? You honestly evaluate the risk and the upside, not just some entrepreneurs only focus on the upside. Very few only focus on the risk. It needs a little bit of balance. So that's why I advocate straight equity in most situations. Why is the safe so popular in a place like Silicon Valley? Because it started out there's a couple of really big incubators. I mean, it's harder to get in these incubators or accelerators than it is to get into Harvard. Like Uber started at the Y Combinator accelerator. And Y Combinator, they have their own lawyers, and they just wanted to have a simple process because the whole idea of the accelerator is we're going to bring a class of entrepreneurs, we're going to pour resources into them, and all of the venture capital funds are just going to be sitting there at the end waiting to gobble these guys up. And we don't want to waste, and we're going for really big seed money valuations. I mean, Uber's first capital was their founders. They put in $200,000. The next round was valued at $4 million. So they went from 0 to $4 million in valuation pretty fast, one round. And they raised $1 million into that round. So the new equity owners, again, pre-money value of $4 million, post-money valuation of $5 million. The new owners got 20% of the company for $1 million, which is if you follow what I'm saying step by step with the $2 million valuation and smaller rounds, by the time you get to $1 million of money raised, you'll be somewhere in that same ballpark. But because in Silicon Valley things move so fast, the idea of the safe there is like, look, you're lucky you even got in because the big players are going to buy this thing up. Don't talk to us about valuation. You either lose it all or you get in at a high valuation and you're going to thank us for that anyway. And as I've said on the blog post at our site, the people who bought in at the $4 million valuation in Uber have made 80,000 times what they put in a 10-year period. That's an okay rate of return, I think. If they sell today, at least, they're doing good. So that's why these kinds of mechanisms evolved. The convertible note is a little even more sophisticated because notes or loans are by custom, by law, they come in first. So if your company goes bankrupt or folding or it's going to be liquidated, the note holders always get paid before anybody who holds equity. Now, the thing I don't like about these convertible notes is generally the companies that are selling these convertible notes have no revenue. If they're a startup, they don't have enough revenue to pay back the loan. So it's kind of a wink. And I don't believe in lending money on a wink. Loans are very, if you honor the integrity of a loan, you would not write a note that you can't pay, right? You should not borrow money you can't pay back. That's what the banks try to tell you, right? And yet these notes, in order to have that kind of wink about the future valuation and the kind of gentleman's handshake that they're not going to try to sue your company to collect. If the company fails, they're just going to throw the note in the trash can. But to me, that's not a good idea. And again, the whole Silicon Valley culture is like, okay, we're going into this accelerator. We're going to throw a bunch of money in. It's either going to blow up and become, this big thing, or it's just going to crash and burn, and we're all okay with it. That's why they got rid of the convertible note, because they didn't want to go through all that paperwork and basically the fantasy that there was really a loan. So these loans, again, these convertible notes are designed to give specialized status to the people who put the first money in the company. And I'm saying we've got to think a little bigger, right? We want to honor our investors, but we also want to honor the entrepreneurs. What this world needs, there's a lot of investors. We need more entrepreneurs, to be honest. And because of that, I'm saying let's just be on even footing. Let's not create deals that give unique preferences to the investors. We've got a whole world to transform. We need to really work together as equal partners. And what these convertible notes do, they create a strange scenario because it's for the professional investor. And again, I'm not against it, but we want to understand what we're getting into when we have these conversations. Let's say I'm a professional investor and I'm putting $10 million into startups and I'm doing it 50,000 at a time. That's a lot of startups. So I'm building a big, diverse portfolio. And I'm saying, well, since I've got the money and you don't know where to get it, and I want preferential treatment, I want a convertible note. Well, now what happens? Your company actually is succeeding. And the note should theoretically convert, but they have the option to request that you pay it back instead. And why might they want to do that? Well, maybe they'd like to pull their money out of your deal because they're invested in some other companies that are growing faster. Now, see how shaky that commitment is to your company's success? Suddenly, the very people that helped you get off the ground are now trying to pull money out right when you're reaching critical mass. And maybe you're growing at 10x a year, where some other deals in their portfolio are growing at 40x a year, and it's out of their desire to make more money, or whatever desire. They've lost that commitment for you. And you want people who are going to hang in there. You want people who are so committed at the beginning, and they just want you to succeed and win. So that is what I'm talking about. I hope that worked. I just got a low battery notice. But that's, again, why I tend to avoid recommending these fancy early stage agreements and just going for straight equity except in special circumstances, which again usually involves one investor bringing an outwardly large size amount of money for your deal. And that's good because that means that they're going to work with you stage by stage and take you much farther with much less effort. So it's a good thing in those cases, yes. Structure those deals in a more artistic way. Again, thanks for listening, and see you in the next video.